In the history of global finance, war has almost always driven gold prices to the moon. It is the ultimate safe haven asset for investors. But in May 2026, as geopolitical tensions reached a breaking point, the textbook was thrown out the window. Gold began a shocking downward spiral. Welcome to the gold paradox. Today we analyze why the traditional rules of macroeconomics failed during the crisis of May 2026. It began at the Strait of Hormuz. As shipping lanes were blocked, the world's energy artery was suddenly constricted, sending oil prices soaring. This oil spike triggered a massive chain reaction. When energy costs rise, everything from transportation to manufacturing becomes significantly more expensive. Suddenly, inflation wasn't just a concern, it was a wildfire. This forced the Federal Reserve's hand into an aggressive stance on interest rates. Here is the trap. Gold is a non-yielding asset. It doesn't pay interest, it just sits there looking pretty in a vault. When Treasury bonds offer a guaranteed 5% return to fight inflation, the opportunity cost of holding gold becomes too high for major institutions. Capital began fleeing gold and rushing into bonds. This massive pivot created a supply-demand imbalance that the market wasn't prepared for. Simultaneously, we saw the rise of the king dollar. In times of global panic, international investors crave the liquidity of the US currency. Because gold is priced in dollars, a stronger dollar makes gold more expensive for foreign buyers, further crushing international demand. But the final blow wasn't about value, it was about survival. As equity markets crashed, traders faced the dreaded margin call. In a liquidity squeeze, you don't sell what you want to sell, you sell what you can sell. Gold is the most liquid asset available. This forced selling pushed prices even lower, creating a feedback loop of panic that defied every historical precedent. So what is the long-term outlook? Despite the short-term noise, central banks are still quietly filling their vaults for a post-fiat future. The paradox of May 2026 was a lesson in liquidity. Don't let short-term volatility blind you to the long-term hedge against systemic collapse. What's your stance? Is gold still the ultimate safe haven, or have the rules changed forever? Let us know in the comments below. During periods of extreme global uncertainty, investors don't just run to gold, they run to liquidity. The US dollar is the most liquid asset on the planet. When the market panics, there is a massive surge in demand for the dollar, because gold is priced in dollars. A stronger dollar makes gold more expensive for everyone else in the world. As the dollar strengthens, global buyers pull back, creating a double hit to the gold price. First from the interest rate outlook, and second from the currency strength. There is a final, often overlooked factor: margin calls. In the early stages of a conflict, if the stock market takes a sharp hit, traders often have to sell their winning assets to cover losses. If a trader is leveraged on stocks and the market drops, they will sell their gold holdings just to raise cash. This panic selling for liquidity creates a short-term downward pressure that has nothing to do with the intrinsic value of gold. The market noise can be overwhelming, but the long-term value remains steady. So should you panic sell your gold? Not necessarily. While the market is reacting to the immediate oil and interest rate shocks, central banks around the world are currently buying record amounts of gold for a reason. They are hedging against the long-term erosion of fiat currencies. Gold serves as a protection against systemic risks, not a day trading tool for the latest military update. If you understand that gold is a long-term play on trust in the system, rather than a short-term play on geopolitical strikes, you'll stop looking at the daily price fluctuations and start seeing the bigger picture. War makes the market volatile, but it also reveals the cracks in the financial system. The current gold paradox is just a reminder that the economy is a complex machine of interest rates, energy costs, and currency demand. If you want to cut through the news noise and understand these macro trends before they hit your wallet, you are in the right place. Subscribe to FinNova, turn on notifications, and let me know in the comments. Are you holding your gold through this volatility? Or are you waiting for the dust to settle? I'm Nova, and I'll see you in the next one.